Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show this week and each and every week. You can hear us, see us in a number of different places. Best place to see us is on YouTube. Go to YouTube, Jeff Barton, the mortgage voice. I pop up. There are hundreds of shows there. If you want to see, hear us each and every week or get alerts when new shows, just click on that you like it. Join up. There are a lot of people that do that, and they get this information delivered to them ASAP through some kind of an alert. Also, Jeff Barton is also on, themortgagevoice.com. Mortgagevoice.com has this show as well as many shows, as well as all the guests, or a good number of them, on the website. It does keep you updated as to what's happening in the world of mortgages. I have a blog there, and there are some articles, as well as keeping up on the daily of what the show is and the guests that are on that show. So if you miss the show or you miss who is on, just go to themortgagevoice.com and you can sign up as well as get that information as you need it. Okay, as again, this is Jeff Barton, and I am the Mortgage Voice. How's that for you? Be very definitive and declarative of this. A lot of things going on in the mortgage industry, as everyone knows. Real estate prices are in a very precarious state in some markets. Certainly most of the markets, I would say 60 to 70% of the markets out there are experiencing a good deal of price reduction, which is a good thing. However, since mortgage rates have risen, it's very, very difficult for a lot of people who were interested in buying a house to get that house. Because if you go from 3% to 5% or 3.5% to 5.5% on any mortgage, it's certainly going to limit the amount of people or lessen the amount of people who are available to get that mortgage. And that is what's happened both locally, and when I say locally, I mean here in Southern California. We're in Southern California, been broadcasting here for, 8 or 9 years. We're also in a couple of other markets that you may want to know about. We're in Las Vegas, 1400 AM K-Ship, and that good group is, I guess we've been with them 3 years, as well as K-Mine down in K-Mine country down in Albuquerque, New Mexico, and certainly up in Tahoe area. All of these areas have experienced some ridiculously high inflation. They call it inflation. They call it equity building when you own a home, and the prices of that home keep going up. All your neighbors keep selling higher and higher, which means your home is worth more. They don't call that inflation. What they call that is good. Well, it is inflation. What happens when that happens is that it prices fewer and fewer people to be able to afford those houses, especially in the areas that most people want to live. And where is that? Well, where I live, it's by the beach, anywhere from the Pacific Ocean to about, even 30 to 50 miles inland. The prices have gotten incredibly high. And I just want to go through a couple of those to give you an idea of what some of the markets that are the hottest markets, actually not the hottest markets, but certainly in Southern California, where I am broadcasting today, we can talk about what the prices are there. Okay, so there's several counties around Los Angeles. Now, Los Angeles to San Diego are some of the most valued properties because, let's face it, California to most people is the West Coast, right? It is the Pacific Ocean. It's the place where if you want to go surfing, you just go anywhere in California and you're going to hit the beach in about 20 minutes. Okay, so some of these counties have seen these price growths, which have really priced out of the market, especially with mortgage rates rising as they have. So that now, when we have a slowdown based on a number of different factors, we've seen those particular homes, I guess, not priced a lot less, but prices are rising more slowly, i.e. if we were going 20% a year, which is what we were doing as of last month, year over year, that would be June, year over year, was almost 20, I think it was 20%, 20.5% raise year over year on a national basis. Locally, it may be higher. Locally, it may be lower. Okay, so let's get into these and what has happened with what's going on in these particular counties. Let's look at Los Angeles County. The median price of home is $860,000, and that's up 8.9% from 2021, same time. So as you can see, it's not 20% nationally, but even that is pretty amazing, right? 8.9%. Okay. Orange County, which is the county just south of Los Angeles County on the ocean side, is The median home price, think of this for a second. You're in Anywhere USA. This particular radio station reaches a lot of different markets, and certainly this particular price I'm going to quote to you is going to sound unbelievable, but the median price in Orange County is $1,025,000. Over $1 million, that's the median price. That means half the houses are priced more, half the houses are priced less, but that median income number becomes very important, especially when we're talking about all kinds of different government programs that you have to qualify for. So to qualify for that type of price, what exactly do you need in order to get the actual loan purchased by either Fannie or Freddie? Well, for the most cases, that median price prices you out of Fannie and Freddie. So you've got to go private label, and that always costs more. But that number at 1.025 million is up 13.9% from 2021. Okay, Riverside County, which is east. That's right, if you're going east, driving to New York from Los Angeles, you get out of LA County and boom, you hit Riverside County. It's a great place to live. There's a lot of things that the desert or hotter living has advantages of. One of them is usually cheaper housing, but this number will surprise you. So the number in Riverside County, 594,000, almost 600,000, and that's up 16.6% from 2021. And down in San Diego, same thing, 810,000 is their median number, and that's up 10%. Now, what we've seen, these numbers, which, as I said, are astounding and high, are going to go up even less this year, which means that more properties will appear on the market. That's key to if you want to get out there and compete for one of these houses. Many people, like many people working, they call it in working the quit rate. They call it when you're buying a house and you just stop looking, they just call that a disgruntled buyer. In either case, the issue of reinvigorating people to want to either get back to work or get back into the market and buy that house has to do with the price of that house and the price it's going to charge you to be able to afford that. Whether you can afford a 5.5% mortgage right now, if you can actually get into a mortgage on a medium price house in some of these counties, it's way above what the loan limits are. Even the conforming jumbo loan limits in LA County are $675,000. Anything over that, you can't get a government loan unless you do a very large down payment. For instance, they'll give you the loan, but if you got $1 million house, you got to put $400,000 down or $325,000 down in order to get that particular product. Okay, so in all of that, the main thing here is price for real estate is going to start coming down in these rich counties. Now, in your county, whether it's Albuquerque, whether it's up in Tahoe, or whether it's out in Las Vegas, they say Las Vegas is going to be one of the areas that will see the greatest drop in prices, possibly anywhere from 5 to 15%. Now, some areas of the country are going to drop more faster than other parts of the country, and that's obvious, right? Real estate, like politics, is local. So if you're looking for a particular bit of information, and I'm quoting these national numbers and these large area county numbers, it's quite possible that the place you're living in is different. You need to obviously follow what's going on in the real estate prices, as everyone does, as well as set yourself up financially. There are 4 different things that the chief economist at Realtor.com talks about when she talks about what you have to be aware of in this real estate market. Her name is Danielle Hale. I read this on Housing Wire. Number 1, inventory is up 18.7% from last year. Think about that. 18.7% more houses on the market this year than last year. That's a good thing. And I bet you right now, by September, when everybody gets settled down and they're living where they got to live because they got kids in school or they've got obligations that they just can't move, moving season is right now. So in September, you're going to see more houses on the market. That's a good thing. Number 2, 1 in 7 homes that are listed saw sales price reductions last month. That's number 2. Number 3, national is not local. I just talked about that. Local conditions rule. So make sure you're very aware of what's going on in your community. And 4, be financially ready. We talked about this, and we talk about it all the time. How do you be financially ready? You have to talk to somebody about what you need in order to get a pre-approval letter which basically states that you have been underwritten for your loan, TBA. TBD, to be determined. That means the property you haven't quite picked out, so the property will have to qualify, but you can be underwritten, and that's DU and that's LP. We talk about that at any time. I'm Jeff Barton, your voice in the mortgage industry. I really appreciate you listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you on a number of different radio stations. If you want to see the show, go to YouTube. Jeff Barton, the Mortgage Voice, is one way you can see not only this show, but we have hundreds of shows there. Best thing to do is to join up, say you like it, so you can get the alerts on the show each and every week. We bring to you guests from all over the industry, whether it's a lender, whether it's somebody who is actually doing loans, or whether it's just an account executive from a loan company telling you about products and whatever else is available to you, decisions that you have to make, changes in the mortgage company, in the mortgage industry have been plentiful this year. And to help us kind of figure that out and to look a little bit forward is Henry Park, who is a longtime veteran in the lending world, who is currently working at Lending 3, and he joins us now. Henry, how are you?
Good. How you doing, sir?
I'm fine, thank you, Henry. And by the way, as I said, I really appreciate all the posts you do. I watch your family travels all over the world. It's awesome.
Oh, thank you. Yeah, I'm actually. It's funny that you said that. I'm actually in Spain right now, as I'm calling in.
Oh, that's unbelievable. Where are you? Down in Marbella? How hot is it there?
No. Oh man, it's around 85 degrees.
Okay, that's not bad.
I'm in Madrid right now.
Oh, you're in Madrid.
Yeah, not too terrible. Yeah.
Well, that's really actually very, yeah, that's nice. I've been to Spain a couple times. I like Spain, but we hear such, we're in the States, so we only get filtered news here. We hear there are fires everywhere. We hear it's blazing hot. What is the situation going on there?
No, well, it's that's just the funny thing. I told my wife that when I got here. So early in the morning, it's like 70 degrees, and I heard that in Spain in the afternoon, everyone takes siestas, and I told her, I said, I wonder why they go to sleep in the afternoon. The dead afternoon. I finally figured it out. So right around 2 to 5 o'clock, it goes from 70 degrees to 80 degrees, and then it goes all the way up to like 95, 100. And then it stays there for about 3 hours, and then right around 6, 7 o'clock p.m., then it comes back down to like 70-something. So that's why people usually sleep in the afternoon.
That's funny. That's a great metaphor for how the rates are going to go. I saw rates go up to almost 6.5%, 6.75%. Now we're back down in the mid-5s. Do you think they're going to stay here for the rest of the year? What is the lending environment like, and where do you see it headed?
No, okay, so, because obviously, as you guys know from last week, the CPI came out at 9.1%,
right?
And which was obviously way higher than what people were expecting. So yes, if you notice that the market did sell off, but if you notice, it bounced right back in, and that's where people was wondering, well, what exactly happened? And so here's what it was, and for me, I've been a bond trader for most of my career. So when it comes to actually look at interest rates and seeing where they go, that's kind of like what I do. But basically, what everyone is kind of thinking is that if you have 2 consecutive quarters of negative growth, you have what's called a recession, right? So right now, with the rates going up and up and up, the reason why they did that was because the Feds tried to slow down this inflationary trend that's been going, ever since. Well, here's the thing: you can't print $9 trillion of money and expect to have a free lunch, right? So that just doesn't work. And so that's why we have a lot of money out there, the money supply chasing fewer goods and services, which is why we have this high inflationary pressure. So what the only tool that the Feds have is to basically ratchet up the Fed funds rate, and by raising rates, they're hoping that they can slow down this economy because it's really, really hot, and that's really what's happening right now. So what everyone's thinking is the Fed is just keep raising rates. The next Fed meeting is going to be on the 26th, 27th, and what they're thinking about is raising it at least another 75 basis points, maybe a point, but I think it's 0.75, 75 basis points is in the bag right now. But the idea is that if they continue to raise these rates, that the economy is going to start slowing down. So we might have that, the peak. If it's not this month, maybe next month, and then it's going to start to head back the other way. So based on my crystal ball, it looks like by the end of third quarter, going into fourth quarter, I think we should see the 10-year in the twos, and then going into next year, my prediction by first, second quarter of next year is going to be in the high ones and going into the low ones. So I think we're going to have probably one of the biggest refinance booms in history.
Oh, I see. I see.
Yeah. Yeah, and here's the thing. I mean, just, and people said, Henry, do you think it's possible? Well, let me ask you this. November of last year, rates were in the twos, right? High twos, 2.75, 3%, and the rates went all the way up to 6. So inside of 6 months, so what goes, it's Newton's laws of gravity, right? What goes up must come back down, and what goes down must go back up. So is it possible? Absolutely, it's possible, because just like it went up, is the same thing coming down. So, I mean, just, this inflation went up really, really, really fast. And, like I said, unfortunately, the only thing that the Fed could do was to ratchet the interest rates up. But like I said, it's going to be very turbulent, because by ratcheting it up, now you're going to see slow down in the economy. And I think that's what we're going to have to do, is instead of doing QT or qualitative tightening, it's going to end up being QE, or quantitative easing, like it was back in 2008.
You're not the first person I've heard say that, although there's so much money, as you quoted. I think it's $22 trillion is the money supply right now, where before COVID it was somewhere around $9 trillion. So it just shows you that there's all this money. With all this money still in people's bank accounts, I mean, they looked at the savings rate and said it's still about as high as it was at the height of the pandemic. How are you going to be able to lower inflation if all this money is still around? I know the Fed has planned to roll off its balance sheet all of the mortgage-backed securities as well as treasuries, but what is the key, other than raising Fed interest rates on your credit card and your car loan, to be able to slow down the country's economy? What is the plan here to get some of this equity out of the market? Do you see anything other than the roll-off being effective?
Okay, so that's funny that you said that. So, in June, the Fed was actually supposed to roll money out of the balance sheet. But here's the big problem. The big problem right now is that in order for them to do that, you remember, the Fed's basically, when somebody refinances and pays off the loan, that's usually when they can go ahead and add new money into the money supply. But the problem is that you have refinance year over year is down by 80% from last year. So right now, if you actually look at and I've looked at the Facebook, and we're looking to see how much money has actually rolled off, we're actually $4 billion more than where we were, before the roll-off. So, I really think that we're in a precarious situation right now, where even though they're supposed to be rolling money off the balance sheet, I really don't think that they can. And so right now, if the Fed was not to prop up and buy a lot of the mortgage-backed securities right now, I think that you would have seen the rate shot up even way further than where it is right now. So to answer your question, this is the pickle, and I think that we're going to go into another scenario, which is what they call stagflation, or stagnant economy with inflationary pressure. So I think we're going to have both. I think we're going to have inflation, but at the same time, we're going to have a stagnant economy.
Okay, so now you're a buyer and you're listening to all this going, how does this affect me if I'm just trying to buy a house and, I've got money to put down, but does this put pressure on house prices to go up, to go down? Where are we in all that?
So here's the thing. I'm a very contrarian way. I have a contrarian way of thinking in terms of investments, right?
Okay.
So it's like Warren Buffett said, it's like be greedy when people are fearful and be fearful when people are greedy, right? So, just 6 months ago, people were crying overbidding on properties, 20 offers going in on the same property. Now, all of a sudden, there's only one offer going in, and now people are crying. This is the way I look at it, right? When the rates go up, obviously home prices come down, right?
Yep.
And when rates are low, then home prices go up, right? So would you rather, I'll look at two different scenarios. Would you rather buy a house that's $800,000, right, with a 3% rate, or would you rather buy a $500,000 house with a 6% rate, for example, right? I'd rather buy a $500,000 with 6% because guess what? If everything goes the way I'm thinking that it's going to go, and you got 2 consecutive quarters of negative growth, and the economy slows down, you know what? You can always go back and refinance, right? With on an $800,000 loan, it doesn't matter with the rate 3%. You still owe the bank $800,000, right? On a $500,000, you buy the house for $500,000. Yes, you maybe got the loan for 6%. You're in it for a year. Rates come back down. You get rid of that loan. You only owe the bank $500,000, so you'll save $300,000. You know what I mean? So
yes,
for me, I think that right now is actually a perfect time to actually buy personally, right? Because I know that when the rates come back down, you're gonna see home prices move back up again. So if you're looking to buy, it's just like this, and I don't mind to digress here, but I had a buddy of mine because I also do investments, right? And right when Bitcoin was at $60,000, he told me, "Hey Henry, you think I should invest?" And I've been telling this guy to buy it ever since it was $1,000. So
right.
So finally, it's at $20,000. He says, and I'm telling him, "Hey, I think you should buy it." He's like, "Oh, I wouldn't touch that thing." So now he doesn't want to buy at 20, but he would have bought it at 60.
Yeah, that's funny. Hey, Henry, right? I'm up against it. I'm so sorry. I loved the conversation. Let's do it again soon. I really appreciate you coming on the show. Thanks.
All right, sounds good. Okay, thanks, brother.
Thank you very much. That's Henry Park from Lending 3. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show. If you want to see us, you can do that on YouTube. If you want to hear us, you certainly can do that on all the radio stations. But we're also on podcasts, a number of different podcasts. And I don't know, 7, 8, 9 of them. Darryl, you have the list there?
It's a bunch.
Yeah.
I think the number's 10, but Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and themortgagevoice.com, to name a few.
Excellent. Podclips.io, that's a great place to see myself, hear myself, as well as a number of other podcasters. It's kind of a place, it's a community, a village where you go, you can see all kinds of different things, whether it's lifestyle, whether it's, in my section, it's finance, whether it's real estate, sports, all those kind of things. Podclips.io, go there, great place. I'm Jeff Barton, this is The Mortgage Voice, and we bring to the show once again Eric Morganson from Angel Oak, who is going to help us determine for all time what is the best thing going on in the mortgage business, especially with some of the programs they're offering over there. Hey, Eric, how are you?
I am very optimistic today, Jeff. Thank you for having me on.
Thank you very much. Okay, I want to light the fuse and let you go. You talked a little bit off air about what's going on with rates and why rising rates is actually something that you've been not looking forward to, but certainly waiting for a long time. And now that it's here, I'm sure you have some products that can really help people.
We do. We are full on in what is known as a cash out and purchase business. There is no tangible net benefit for anybody to refinance their mortgage. Most folks are in mortgages in the 3s, so who's ever going to touch those?
Right.
Now, but yet again, we still are seeing home appreciation, so it's a lot better to buy a house than it is to rent, even with the higher interest rates.
Right. Right. No, I agree with that 100%. Are you worried that if people start pulling money out and real estate prices drop, that there's going to be an issue with, either your company or other companies going upside down?
No, we're not going anywhere. As a matter of fact, we're very bullish on the future. You realize that there is trillions of new equity in properties out there, and it's all about supply and demand, Jeff. There are more people looking to own a house than there are available houses.
Right.
So that's why we're never going to see what we saw during the financial meltdown where all these houses went into foreclosure. Who in their right mind is going to let their house go into foreclosure at this point when they can simply sell it and take that equity off the table? There are people that might be addicted to drugs or alcohol or not mentally stable like a hoarder, And those are the only properties that you'll ever see that would even come close to going into foreclosure. But we're very bullish on the housing market going forward. You guys, it's literally over the last 10 years, the cost to build a home in lumber, in the wiring, cost of copper, everything has doubled. So it's a lot more expensive to build a house right now. So again, very bullish. And I want to focus on the purchase market out there.
Okay.
With all of the self-employed people out there that literally never before in the history of American housing industry and mortgage do you have this. You have the ATR regulation standing for the ability to repay, coupled with the fact that you have, 56 million self-employed Americans out there, a lot of them in the gig economy, and now you have somebody that can document, $136,000 worth of their legitimate tax deductions to the IRS and turn around and buy a $2 million house based on their bank statements or what they're depositing their cash flow into their business versus what they're telling the IRS with what our 70,000-page tax code that we have in this country. It's a very sophisticated document. So if you can't qualify for a mortgage and you're self-employed based on your tax returns, you have this amazing option to go with a bank statement loan.
And that's a business bank statement loan, personal bank statement, both?
Either or. They're priced the same, whether you're doing a business bank statement loan or a personal bank statement loan. And the number one vocation, the number one occupation for bank statement borrowers in America today is, guess what they do for a living, Jeff?
Drive Lyft.
We do a lot of Lyft drivers and Uber drivers, but no, they're real estate agents.
I should have known that one, huh?
Yes, real estate agents were the first ones really introduced to bank statement loans with, their self-employed clients that were trying to buy a house, and they found out, how did you qualify? I've been trying to sell you a house for 10 years, and they go, I found this lender, like Malibu, to do a bank statement loan for me. So they go, I want one because, look, real estate agents are all self-employed. They're writing everything off they possibly can, and now it's time for them to, here's a wonderful opportunity that they stumble upon, and guess what? They before never could qualify. We literally document 85% of what a realtor deposits into their personal checking account, and we use that to qualify them for the loan, and they are delighted.
Your company, Angel Oak, went through some pretty hefty growth over the last 2 or 3 years. How are you positioned for this market going forward? Obviously, you're looking at some of the cash out stuff and purchase market, absolutely, with the different programs that you offer. But do you see, now, as you well know, there are some lenders that went out of business, whether it's Sprout or whether it's First Guarantee. How are you positioned? Where do you see that demand coming from for your business?
Well, the demand right now, before I got on this, my phone's ringing off the hook. See, everybody, like loan officers, professionals like you, were helping people do rate and term refinances. A lot of tangible net benefit going from a 5% interest rate down to a 3% interest rate. But that party is over.
Right.
So now loan officers are like, well, now what am I going to do? You see all the layoffs in the mortgage industry.
Yep.
The smart ones go, geez, these non-agency loan programs, I'm really, you know what, I'm going to dust off these rate sheets again and go, hey, I'm going to contact them and I'm going to figure those out right now, and that's what we're seeing.
Excellent. Now, the rates for non-QM type products, which you're talking about, vary, and they vary based on the borrower's credit. They based on the amount of money down, like any loan. But are they in ratio the same way they were, 16 to 18 months ago with conventional loans? Usually it was about a point and a half difference. Is it still that way? If we have, for instance, a conventional at 5.5, are we looking at 7.5% for non-QM type loans?
Yes, that is exactly right. Doing a no-doc loan, like on an investment property, never was supposed to be the same rate as you and I, as taxpayers. We personally guarantee Fannie Mae, Freddie Mac, VA, FHA loans. Those are all backstopped by the U.S. government. This is all private capital. So private capital has a different bogey to hit. It's not subsidized, number one. Private capital is a little bit smarter on risk, where look at our government is funding loans at 97.5% loan to value and at a low rate. Geez, the borrower only has to put, let's say, 3% down on a FHA loan. Are you kidding me? What happens if the market corrects 10%? So, no, private money is a little bit smarter than government money, let's just say.
No,
the rates are going to be traditionally about 1.5 points higher than going full documentation to agency. Yes, sir.
Now, a lot of people get scared about prepayment penalties and the like. I don't know if they exist in some of the loans you do.
At Angel Oak Mortgage Solutions, there is no prepay if it's owner-occupied. There is a prepay penalty of 3 years on non-owner-occupied or investment property.
Like that DSCR.
So with that said, the borrower can buy it out either in rate or in fee. But, I mean, these loans are 30-year fixed. They don't balloon on the borrower, or you can go 40-year interest only, which is nice as well to keep the payment extremely low. And no, these are high-end demand programs. And listen, real estate is not going anywhere. We're not going to see it. We're not going to see the free fall back to the financial meltdown days.
Agreed.
Where these people didn't qualify for a loan. Nobody could really afford it. Now we have the ATR regulation.
Right.
For the folks out there, January the 10th, 2014, the CFPB delineated what is a qualified and a non-qualified loan. These are non-qualified loans that have a law that every borrower in America has a 3-year statute of limitation to sue their lender for their inability to repay their mortgage. Now, if your mortgage is with Fannie Mae or Freddie Mac, agency, FHA, or VA, you can't sue them. But you can't sue a private lender on your owner-occupied property for your inability to repay that loan. So this is the type of lending Angel Oak Mortgage Solutions does.
Excellent. Eric, could you shout out your phone number, let people know how they can get in touch with you? These are great programs. People have to know about them, and if they have questions, how do they get you?
My cell phone is fine. That is 949-554-5000. Again, that's 949-554-5000.
Hey, it's nice talking with you again. Hey, you sound upbeat. I love you. I'm going to plug into your interview every time I need a little lift.
Oh, Jeff, it's so fun that delighting people that thought homeownership was that wasn't for them. It truly is, and boy, do they ever smile that 2 months later they see that their house is appreciating at a faster rate than their own salary. It delights them.
Excellent. All right, I got to go. I got another interview. Thank you very much. This is Eric Morganson from Angel Oak. Eric, thanks very much.
Thank you. Bye now.
Thank you, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We bring to you guests and people who are from all of the different disciplines within what we do. We just had on Eric Morganson from Angel Oak. We had on earlier Henry Park from Lending 3. And our next guest been on the show several times, a celebrity of sorts, of course, always very educated in the real estate market. She works for Realty One out in Las Vegas. She's been on national television a number of times, a number of different shows. Janti Chun joins us now. Janti, how are you?
Hey, Jeff. Good. How are you today?
I'm fine, thank you, and thank you very much for coming on. I really appreciate it.
Absolutely. My pleasure, always.
Okay, so in the lending environment, we always look to supply and demand. If, rates go up, it kind of hurts demand a little bit. What is demand like in Las Vegas? I read some things that I'm not sure are true, but I'd like a firsthand, overview of what's happening there. What is happening?
Well, it depends on what agent, you ask,
right.
or what type of investor you ask. It depends on all that. what I noticed is there's a lot of different reports, coming all over the country, and I have a lot of friends that would send me stuff,
Right.
from other places.
That's annoying.
Where they read.
Right.
Yeah, right. And no, it's fun. I love
Okay.
the information, and I love the knowledge. So there's nothing wrong with that. But I tell them, I go, look, don't base this on a certain market, because just because it was written somewhere else doesn't mean it's prevalent through the whole country.
Right.
It depends on the area, it depends on the state, it depends on the city, it depends on the zip code, it depends on a lot of different things.
Right.
So what's happened in Las Vegas is, we have a little bit more supply. I mean, we're talking about going from 1 month supply to about 2 months supply now. So, within the 6 months, right?
Right.
So it's double within the 6 months. But remember, a stable market is still 4 to 6 months.
Okay.
Right?
Yep.
So I tell people, please don't get all crazy, and don't, believe the hype, and don't, there's still good deals. It's still a seller's market, unfortunately, but the sellers are actually a little more realistic now. They're not trying to get $50,000 to $100,000 over market value anymore.
Yeah,
they're
I do.
About,
I do.
Yeah.
So you represent a lot of investors. People come to town looking for that. Are they still looking as much as they were? And are they looking to purchase in order to rent out? What are investors doing with their properties? Are they flipping it? What are they doing?
It's across the board.
Okay.
I still have investors. And I still have people just calling left and right looking for deals. Obviously,
right.
Those investors every single day. You have no idea. Every single day. And I'm like, well, and I tell them, I go, well, if there's those deals, 30% below market value, 10 to 30% below market value, you can rest assured that I'm going to buy it. I'm not going to give it to you.
Exactly. Why would I give it? If I want to wholesale the property, maybe, but, exactly, if you found that. Do you do much of that?
Exactly.
Do you do much of that wholesaling at all, or is it strictly you're looking for investors and you're collecting commission, or what other avenues of business are you employing out there, especially in a market like this?
Well, I am not wholesaling.
Okay.
Now, I know a lot of people out there are doing that because it's a fast, easy money in a very short time. We're talking about weeks.
Right.
But no, I don't do that. I do more of the renovation and the flip. So I do take a little bit of time, and I want to maximize on my, return of investment. Right.
Of course. Yep.
So I want to get 30 to 100% money back. So I do not rush it. That's what I do as a flipper. Now, what I've done recently is, there has been maybe a few people out there or across the country that has issues with, whatever, the payment or whatever. I mean, there's not any foreclosures, obviously.
Right. Are you there? We're talking with John T. Chun, who is joining us from Las Vegas, Nevada. We may have some more technical difficulties. However, when talking about flipping, there's a lot of different ways that you can actually do the flipping market. And one of the reasons that I brought her on was that she's been doing the flipping market for quite some time, i.e. you buy the house, you look to see what it's going to cost you to put whether a new paint job, a new roof, maybe new kitchens, cabinets, maybe even some rework of the property. Now, she is talking about anywhere from 30 to 100% return on your money. In the wholesale business, which is a different side of the business, you find a property, you secure the property in a contract, then you sell that contract to somebody else. So your margins there are anywhere from 10 to 20%, a little bit different. I think she joins us now. Excellent. John T., how are you? You're back.
Here. Yeah, hi, here I am.
Okay, very well. So we were talking about flipping, about your wanting to get anywhere from 30 to 100% in the flipping business, and finding those kind of properties, even though you're saying right before you got cut off that the foreclosures really aren't there. There are no foreclosures. So where are you finding these good deals? Is it a ferret out? Is it just combing through the MLS? Is it other than the MLS? Where are you looking to find those?
Everywhere, right? So now, historically for me, I just comb the MLS, and I look for, properties that meet that criteria that I'm looking for.
Right.
But lately, within the last, within this year, I've met people just traveling that have, that's going through certain situations and circumstances, financially for themselves.
Yep.
And even though they're not upside down, I can advise them on what to do. And now I have helped some individuals basically with remodeling and flipping and stuff, and then becoming their partner instead of, going in as an investor and going, I'm gonna maximize this opportunity and take advantage of these people, and then buy it from them at a low price. I don't do that. Now, there's plenty of investors that will.
Right.
I'm just more into, helping people, and I'm a Buddhist, so I want to help people. And so the last few deals that I've done is these individuals have found me for some reason, and I've helped them basically, and then made them money as well. So
sure.
Becoming their partners. Yeah. So and that I find a lot of joy in that, instead of being an investor and going, you know what, I'm going to give you, whatever, $100,000 less for your house, and just buy it from them like that. So no, I haven't done that, even though I had the opportunity to do that.
Yeah, I like the idea that you go in, you be partners with someone. Maybe they don't have the fix-up money in order to maximize it. They want to get out, but they want to make the most they can, so that you can offer them really the fix-up money, or however your expertise that you bring in, to enhance the value of the property to such an extent that it's a win-win for both of you. That's a great way to do it.
Absolutely, yeah. So, but, there's still deals out there for investors that are looking. And obviously not a lot, and but the market is good. So as a buyer, it's still a good market. You can still find some deals, maybe not crazy deals, but as a home buyer, the market is right for it. And this impeding talk of the crash, everyone's all scared. And so I tell people, look, don't follow the herd, please. Yep. Don't believe everything you hear, and definitely don't read everything. Don't believe everything you read either.
What are they going to do with Lake Mead? I went up there, and it looks like a small puddle compared to when I first started coming to Las Vegas. I'm like, where is the water coming from? Are they going to fix that? What's happening?
Well, of course. That has been a concern for the last couple of decades. It's not just
right.
now.
That's true. No, it's true.
Yeah.
But I never saw it this low. That's the thing.
Yeah, well, what we're going to have to do is we're going to have to cut you Californians off.
Well, you know what? It's funny you say that, because, yes, California does take a lot of the Colorado River, and, yes, there are definitely multi-state agreements who gets what. I think really what they should do is build a huge saltwater pipeline and a desal out in Vegas and just suck it up from the Pacific Ocean. There's plenty of water there.
Absolutely. No, we'll find a way. We're resilient creatures. We'll definitely find a way. And, hopefully you guys, California and Utah, you help us out too. You're not going to let us die, right?
Well, I always like going to Las Vegas. Hey, it's my home away from home. I go there all the time. So, yeah, it's probably, I'll bring a glass of water next time I come out. There's, I don't want to take any of yours. Okay, so we got about 30 seconds left. Could you let people know how they can get in touch with a terrific person, especially if they're in that business or need a great real estate agent to find them a property out there?
Absolutely. Please give me a call. I'm all over social media. Jean-T Chun with Realty One Group, and my phone number is 702-467-3131. Love to help you.
Thank you very much, Jean-T, for coming on. You're always a pleasure, and I really enjoy having you on the show. Thanks for coming on.
Thank you, Jeff.
Thank you very much. Thank you. Jean-T Chun from Realty One. I'm Jeff Barton, your voice in the mortgage industry, and we will be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We see and hear this show all over the place, but if you are driving around in your car on a Saturday afternoon and you want to hear traditional radio, guess what? We got you covered. We're on 5 different stations in 3 different states. KSHP, that's K-Ship in 1400 AM in Las Vegas. We're on either Saturday or Sunday. Which one is it? Do you know?
I believe it's both.
Okay, very good. Yeah, usually at 3 o'clock in the afternoon, and that's prime time when you're driving around trying to fix stuff at your house and you're looking for Home Depot or whatever it is that you need in order to do that. Also, we're on K-Mine Country down in Albuquerque, New Mexico. Those fine folks down there put us on, and I believe we're also on Saturday at K-Mine, K-Tahoe. We're up in Lake Tahoe area, anywhere from I guess Sacramento all the way to San Francisco, you can be heard depending on the day, but we're pretty strong up there in K-Mine country, as well as K-Tahoe, and of course, two of our flagship stations, KMET in Southern California and
KCCA.
KCCA, absolutely, and really appreciate those. You know, those stations have really, we've been on those almost 10 years, and they bring us to a very wide audience from San Bernardino all the way east to LA and west out to Palm Springs, north and south to Indio, and south down to some parts of Orange County. Really appreciate that. Great people over there, and again, if you want to hear us, those are the places you can do it. I'm Jeff Barton. This is the Mortgage Voice. I can't speak today because I'm speaking too fast. Too many words come out of my mouth.
Neither could I. It's KCAA.
KCAA. What did I say?
The guy was just squirming in his chair. I don't know. I said KCCA.
Sorry, Mark. I didn't mean to say it like that. I'm sorry, Fred. KCAA. Those are our people. And I knew I said it wrong as soon as I said it, but you know, when you get on a roll, you just start talking and things come out and you just don't know what you're saying. Anyway, let's get to it. All right, now we talk about a lot of different things on this show and how it affects your real estate decisions, your mortgage decisions. Certainly the guests we bring on talk about the micro, what's happening in that lender, what's happening at this particular person's office or at this shop. One of the things that we talked about last year through this year is what's happening in China. Now, why does that matter? Well, China makes a lot of stuff, and we got drunk on Chinese cheap goods many, many, many years ago, back in the dot-com bubble. So whether you're Walmart or whether you're Amazon, we're buying Chinese products. And as a result of that, what does that do? It gets us to where we're exporting dollars to China based on whatever it is they're making that we're buying. Well, I don't care what it is, it's made in China. Now, we've had some issues with inflation due to a lot of things about what's going on in China and what's going on in Russia because of the war. These things are holding up either the transportation of the goods or the supply of the goods. Now, all of that has to do with supply and demand and everything else. But if you can't get things that you want, if you still want them, it's going to cost you more, and that's part of the problem with what's going on in China. So how is China dealing with their real estate sector issues? What are the real estate sector issues? We've talked about that. There's about 26, 27 different builders, development companies in China, probably even more by now, which have defaulted on their bonds that they needed in order to. Now, China went through a 40-year remake of their country, right? They have a huge middle class. Part of the reason that middle class has, made China more of a consuming nation rather than an exporting nation, which is the goal, is because of real estate, owning property. Now, how they do it there is the development company will borrow money. They will say, okay, we're going to build X amount of houses. Then they go to the market and say, you newly minted middle class people, you're going to buy this real estate that I'm going to develop from the bond money that I just borrowed. But in order to do that, you got to get a mortgage for the unbuilt property now and start paying on that mortgage now. So they pre-sell all these things, and because of the nature of how the supply and demand works there, they're bellying up to the bar and buying these things before they're built. Now, if you're in the U.S. market, you would think that's absolutely insane. Well, that's not what they were doing there. Okay, fast forward to today. Most of the middle class buyers in, what's the number? Okay, there are 301 projects in 91 cities. 301 projects in 91 cities that prepay before you own or before they're built arrangement, there's a boycott, and the borrowers are boycotting their mortgages. Now, what does this mean? This means that the money they borrowed in order to build these particular units, they went into default, and they went into default because the value of the properties went down, and people said, I don't want to buy these anymore. But the people that had purchased and were paying on mortgages were still paying on mortgages of properties that weren't even built and may never be built because of the default on the bonds. So what happened is that you have in these 91 cities, 301 projects, you have a lot of the mortgage holders refusing to pay the mortgage, only making the entire process even worse. The real estate sector in China, I've always tried to educate by saying, look, this is a problem. This makes what we did in 2008 look very similar. Now, we in the U.S. don't have to worry about that. And people say, oh, my God, are we going to get the tightening that we had in 2008? We're going to get the shutting down of the ability to borrow just like it was in 2008? Well, if you know anything about credit and how credit is available in the U.S., we have never gotten out of the inability of credit to match the levels of 4, 5, and 6. It's been at the levels of 2008 since 2008. The credit box, what they call the ability of your lender to lend you money at easy terms, hasn't been easy since the crash of 2008. So the fact of that happening again, not going to happen again. And the loans are good. And, people are working. You see the unemployment numbers as well as I do. Whether you believe the politics of it, people are working. The reason people are not working in certain areas and stores, and you see help wanted ads everywhere, is because you had 5 to 6 million people just quit their jobs and not going back. That's one of the reasons. Now, reverse that back out to where China is right now. They're in trouble. 25% of their economy is wrapped up in this whole real estate issue. And that's a problem because right now we have lockdowns in their second major city. Anytime there's a COVID sniff, they lock down an area. We have inflation all over the world as a result of problems with the sector of delivering of goods and making of goods. And now we have the real estate sector in China imploding. Now, what is the Chinese response to all this? They look and had looked to lessen the terms of the availability of credit. The availability of credit to the builders. So I went looking around. Okay, what is the Fed funds rate, or the I guess whatever similarly named it is in the European Union? It's the ECB. In China, it's the People's Bank of PBC or something like that. People's Bank of China. What is the interest rate in all these countries? And how does the U.S. stack up? Well, we look at how fast the Fed is raising their particular interest rate. And of course, that short-term rate on borrowing bank to bank, it's going to affect your credit card, your car loan, blah, 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 blah. Okay, so let's look at, let me just get to a couple of these because it just shakes your tree when you think, okay, here's a country, Argentina. You say, okay, how bad could it be? 52%. Okay, you want to get a loan from that bank to bank down there? It's going to cost you 52% on a yearly basis. Now that's high. And that even beats the war countries, Ukraine and Russia. Ukraine, 25%. Russia, 20%. Okay, let's just whizzle on down. Turkey, 14%. Let's look at a couple more of these. Let's get to China, 3.7%. Now, the U.S. comes in right near that, and the U.S. is at 1.75%. So the short-term interest rate in the U.S. is still among the lowest in the world. It's probably out of these, I don't know, I have 85, 90 countries here. It's in the bottom 10, 11. Only Taiwan at 1.75, that's like the U.S. Sweden at 1.25. Switzerland at 0.75. That's negative 0.75. They almost give you money to lend. Anyway, lots going on. Hope you followed all that. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next week.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Express 106.5 FM. The #1 FM.